Welcome to today's Explainer. We're breaking down the incredibly complex financial engine of Allianz to figure out if its stock is a buy, hold, watch, or sell. I'm literally thrilled you're here because we're going to reframe how you think about one of the most foundational sectors in global finance. Look, people often brush off insurance companies as these slow, plodding, kind of boring defensive plays. But when you really look under the hood of a titan like Allianz, you see something completely different. You see a highly tuned, highly sophisticated engine of risk. Today, we're dissecting exactly how that engine works, how it generates just a massive amount of capital, and ultimately whether it deserves a spot in your portfolio.
Okay, let's jump right into the agenda. We've got 5 key areas today. First, the business of risk. Second, the dual profit engine. Third, capital and dividends. Fourth, the biggest risks. And finally, number 5, the final verdict.
Section 1. The business of risk.
I want you to imagine a wild scenario for a second. What if you could own just one company that collects insurance premiums from millions of customers and then turns around and invests billions of euros of that exact same money on the global market? Think about the sheer scale of a business operating like that, taking in millions daily from regular folks and massive corporations, and before paying out a single claim, putting that monumental mountain of capital straight to work. You're not just betting on their ability to write a solid policy, you're betting on them acting as a colossal investment fund.
And that brings us to this 3-pillar approach: insurance plus asset management plus global capital. This right here is the true Allianz model. It's an absolute wealth-generating machine when it's running smoothly. They take that foundational stability of insurance, smash it together with top-tier asset management, and fuel the whole shebang with global capital. It's this exact structure that separates Allianz from your run-of-the-mill single-focus insurer.
So, as of our research date in August 2026, here is your quick investor snapshot. A super important note for our American viewers. We're looking at the OTC ticker ALIZF. Now, the underlying company is exactly the same, but remember, as an over-the-counter security, things like liquidity, bid-ask spreads, and currency conversion are going to differ from its primary Frankfurt listing. We've got the overall risk pegged as medium, and the baseline strategy? Buy on pullbacks. But to really grasp why, we've got to look closer at how they actually make their cash.
Moving right along to Section 2, the dual profit engine. The secret sauce to their extreme resilience is how they split their operations. You've got roughly 40% in property and casualty, another 40% in life and health, and 20% in asset management. They aren't overly reliant on just one stream going perfectly, you know? The real beauty of this model is true diversification. If property and casualty takes a massive hit because of, say, a brutal year for natural disasters, asset management or life insurance can just step right up to compensate. It's a fantastic safety net.
Now, to wrap your head around the traditional insurance side of that equation, you absolutely have to understand the magic insurance number, the combined ratio. It's elegantly simple, really. It's literally just the premiums they collect minus the claims they pay out, minus the expenses to keep the lights on, which ultimately gives you the underwriting profit. This one singular number tells you in a heartbeat if they actually know what they're doing when it comes to the core business of underwriting risk.
The absolutely crucial point here is staying under 100%. Something like a healthy 95% means management is effectively controlling pricing and risk. They're turning a solid profit on the insurance itself before they even start investing the money. But as that number creeps up to, say, 105%, yikes, they are paying out more than they bring in. Allianz has historically maintained a super strong, disciplined underwriting performance. That's a massive green flag for investors, telling us the core engine is running cool and efficient.
But hey, Allianz doesn't just collect premiums. They also own major asset managers like PIMCO and Alliance Global Investors, which act as a massive hidden engine for the company. To put this into perspective, PIMCO manages trillions in global capital. Trillions! It's one of the world's absolute largest fixed income managers. When bond markets look attractive, PIMCO brings in staggering amounts of cash. This isn't just a little side hustle. It generates long-term, recurring revenue through management and performance fees that beautifully offsets the unpredictability of random insurance claims.
All right, Section 3, capital strength and dividends. Because at the end of the day, strong earnings need to translate into real money in your pocket, right? For income investors, this 3-step dividend checklist represents the holy grail for getting substantial excess capital returned to shareholders. First, you want to see operating profit rising, proving those dual engines are working. Second, you want the solvency ratio going up. We'll touch on that in just a sec. And third, you definitely want to see that dividend per share climbing.
When all three of those arrows are pointing up, you've found an insurer that's seriously compounding wealth.
But keep in mind, none of those sweet dividends happen without a rock-solid Solvency II ratio. This ratio basically measures their available capital against their required risk capital. Think of it as the ultimate financial armor, protecting the company from sudden, catastrophic shocks. It ensures they've got enough cash to survive worst-case scenarios, whether that's a crazy interest rate shock or a nasty string of natural disasters. A strong ratio means protection, for sure, but it also gives management the flexibility they need to confidently hand that excess capital back to you.
Which brings us to Section 4, the biggest risks.
Because every fast-moving machine has brakes, right? For Allianz, those brakes are immense global risks. There's a fascinating contrast here between climate risk and financial risk. On one hand, you have catastrophe risk. Think extreme weather, floods, hurricanes. These trigger sudden, massive spikes in claims, and boom, a direct hit to the combined ratio. On the other hand, you have market crash risk. If global markets tank, the asset values managed by PIMCO plummet, and those lucrative management fee incomes drop right alongside them. This makes Allianz a really fascinating hybrid. It's both a defensive stock and a highly market-sensitive one.
And listen up, if you're an American OTC investor buying that ALIZF ticker, you absolutely must factor in currency risk. Because Allianz reports in euros, your total return is a math equation that depends on both Allianz's core performance and the movement of the euro against the dollar. A super strong dollar can completely eat into your returns, while a weak dollar can amplify them. It's a critical extra layer of risk that you have to watch like a hawk.
And finally, Section 5, the final verdict. So, weighing those powerful dual engines against the sudden breaks of climate and market risks, where do we land? Well, here is your definitive scorecard. You want to buy on pullbacks when market fear creates a cheap valuation, assuming the underlying underwriting stays strong. You hold if capital is strong and earnings are steady, because honestly there's no good reason to overtrade a stable compounder. You watch if the market is just broadly weak but fundamentals are intact. And actually, this is the really critical one. You sell or take the warning immediately if capital deteriorates or that combined ratio persistently sits over 100%.
So tallying up their incredible franchise strength, their dividend reliability, that global diversification, and weighing it all against their catastrophe and market sensitivity, Allianz earns a highly respectable overall investor score of 8.9 out of 10. It's just a remarkably high-quality financial institution with a deeply entrenched market position.
When the U.S. exchanges reopen tomorrow, here is your watch list. These are the 5 absolutely critical numbers you need to keep tabs on: the combined ratio, operating profit, solvency ratio, assets under management, and dividend per share. If the combined ratio is disciplined, profits and solvency are strong, PIMCO's assets are growing, and the dividend is secure, well then you know the engine is humming perfectly. These are the exact metrics that tell you if Allianz really belongs in your long-term portfolio.
Ultimately, Allianz profits from the oldest business in the world, risk. Every single day, people insure their cars, companies insure their factories, and capital flows globally, with Allianz sitting right in the middle collecting its share. But as the old saying goes, insurance looks boring until the claims arrive. The true test of this stock isn't how it performs on a sunny day, it's how its capital holds up when the storm hits. So looking at your own portfolio, ask yourself, when the next big global financial storm makes landfall, is Allianz the armor you want protecting your wealth? Thanks so much for joining me for this explainer. Keep your eyes on those 5 critical metrics, and I'll catch you next time.